doing business in Africa. You can't afford to be without Africa Investor.
And thank you, everybody. I think hopefully we've got a sort of a sense of the institutional industry that has an interest in the continent and how accessible we all are in terms of being able to work together. But there are mechanics. There are mechanics to how norms and fiduciary responsibilities are expedited, and I think that's really where we think we can bring our two worlds together. We sort of have a culture that focuses on let's find projects, and then let's take as long as it requires to diligence and potentially develop and finance, operate and maintain those assets. We believe that the only way you can look at scale in terms of intermediating the opportunities on the ground with the large institutional pools of capital is if it can become an asset allocation issue. So if we can say, how can we position ourselves to attract a percentage of the 300 trillion, as opposed to how can we finance, tens of millions or billions of projects? And that's where a big disconnect has existed. So I'm going to come to you now, Rich, because you, as you say, you advise on over 6 trillion, and how do we get to, and you're working very closely with us in the SMI Africa Council, how do we get to this issue of making African green industrial infrastructure and all of the great endowments that we have, that the world is already investing in one form or another? How can we conglomerate that so that the value is added in the continent and investors can participate in the upside of that in the continent and help the just energy transition, but also still deliver climate risk and nature-adjusted returns? So perhaps you might tell us what your advice would be to the community, or how we should think about positioning African green industrial infrastructure as a globally competitive investable asset class. Small question, huh?
Okay, sure. So I'm going to give you a free consulting project right now and take you through the logic I would of a sovereign wealth fund or large national social security fund that's hired us to do asset allocation for them. And long term, I'm very optimistic about this because of three opportunities. So just run the math for emerging and frontier market infrastructure investment versus other asset classes that could be in your asset mix. It's going to have a better expected return than developed market infrastructure, because the perceived risks are higher. The actual risks may or may not be higher, but the perceived risks are higher. But the diversification potential across countries, 54 countries in Africa, other emerging frontier markets around the world, no two of which behave in the same way. So you get this mix of diversifiers that you can't get in developed market. And unlike public stocks, you can invest in NVIDIA, Microsoft, Apple, and arguably you're getting exposure to the global economy because they sell everywhere. But infrastructure projects aren't like that. They're very local. You're with the local GDP, the local political risk, on and on and on. So the diversification potential is much higher. When we run those numbers for any type of investor, even if they have no overlay on climate, no overlay on any SDG, no overlay on ESG at all, the allocation to emerging frontier market infrastructure goes to whatever maximum constraint they put on it. It's a super attractive asset class just on the merits. So now come to the climate overlay or other SDG overlay. Well, if you put another dollar in green infrastructure in Europe, where the emission curve's already been bent, and where the amount of infrastructure and green infrastructure investment being made has doubled over the last 10 years, you're having some impact on climate mitigation. You put that same dollar into Africa, and you're replacing decentralized diesel generation, or you're replacing charcoal, or you're replacing coal at a much higher rate than you would in Europe. The marginal benefit of doing it in Africa or elsewhere in the emerging frontier markets is much higher than doing it in the developed world. So once you put that climate overlay on it, whether you're doing it for risk return purposes, universal shareholder, values alignment, impact, wherever that overlay is coming from, the bang for the buck that you get for doing it in Africa is higher. So again, another opportunity. And then the third opportunity, and this is kind of the clincher, is with any fund that thinks of themselves as sophisticated, and larger funds tend to have in-house staff, they don't get paid to be like everybody else, they get paid to do it better. We say, well, in any area of investing, if you want to outperform, you need to be early and be right. So a year from now, when we take your peers through this, are they going to see it the same way? And do you want to get your money in now and have them buy in behind you, or do you want to wait until this is well established as asset class? So those are the opportunities. The math goes there without an ESG overlay. The ESG overlays are very strong, and you can be early and be right. Now let's go to the challenges. Anybody who's been peer group median benchmarked and has underweighted the U.S. large cap stock market or the Magnificent Seven has underperformed. So investors that have diversified in the short term haven't underperformed. That'll change at some point, but there's a strong tendency to say, why bother? We're doing well with what we have. Another challenge, the general partner community, even where they raise global emerging frontier market infrastructure funds, we've been very disappointed, but most of them don't allocate to Africa. They see it as too hard. They see that there's no country on the continent with an investor-grade sovereign rating. So how can we do infrastructure investment and tie up the money for that long with that kind of underlying credit? Now, there's lots of ways to mitigate that and so on, but where I'm going is the investors, having established the asset allocation, have to really police their general partners strongly if they want the money to end up in Africa or in emerging frontier market infrastructure. And another challenge is the recent underperformance of China. To the extent that large investors stepped out and started doing emerging frontier infrastructure investment, they started with China as the world's largest emerging economy and got burned by the last 3 to 5 years change in political environment, market environment, economic environment in China. And so that's put a blunt on it. But I see all three of those things, those challenges, as short-term and transient, and have some optimism that long-term, just the math and then the bang for the buck argument, and then if you want to outperform, you have to be early and be right, will drive money into this asset class.
Fantastic. Let me just follow up. We talk a lot about adding value to our resources and our endowments, and then accessing the $10 trillion per annum and growing global green industrial economy. And a number of colleagues here, we've just formed a partnership as the SMI Africa Council with some of the larger demand coalition networks like First Movers Coalition, Clean Energy Buyers Alliance, Energy Peace Partners, and a number of others. To what extent do you believe that these demand coalitions that effectively offer long duration bankable offtakes, because classically they were market signals to project developers to get over the greenium, to get over that sort of cost of not being able to get to scale. How could they be used, in your view, to recharacterize risk if there's a long duration bankable offtake for, in the context of asset allocation?
I think that could be huge, because one of the big concerns of investors is around the currency risk. And although that's arguably a diversifiable risk, it's a very real risk. And I kind of beat up on the general partner community earlier and said they're not doing Africa. They view it as too hard. The problem with the general partner community is they're trying to get 12% or so IRRs, and they don't care where they get them. So if they can get that from doing U.S. green infrastructure investment under the Inflation Reduction Act, and that's in line with their mandate, if that's easier and they can get their 12% IRR, the principal agent issue is they'll try to do that. So the institutional client has to come in over the top and say, no, we've got plenty of U.S. GDP exposure, we have plenty of Western Europe, we have plenty of Japan, we need exposure in the emerging frontier markets. But then you get to the currency risk, the political risk, so on. So I'm gonna use a specific project that some of you may have heard about, which is the X-Links project, Moroccan solar and wind power being sold to the UK. One of the really elegant things about that project is that your counterparty, the buyer of the energy, is in pound sterling, and it's national grid, so it's effectively, arguably, the UK government. You don't have to hedge the currency risk. You don't have to hedge the counterparty risk in that one. So what you mentioned, the offtake coalitions don't even have to get involved, because your offtaker is a hard currency, sovereign, high-quality credit. That's brilliant. In many other deals, you're producing green hydrogen for export, you're somehow trying to get energy to global markets or even to local markets. That's where the offtake coalitions could come in to effectively do the same thing. Say, if you're going to invest hard currency and take this very high degree of currency risk and counterparty risk and so on, we'll come in over the top as another instrument besides political risk insurance, trade finance insurance, credit enhancement insurance, but a much more economic hedge. We'll do a contract for difference. We'll do something that effectively guarantees a price. And now the project just has to produce, because those other risks have been mitigated by the offtake coalition setting in and putting a collar around that.
So doable.
I think it's doable. I think in general we're struggling forward to 2 steps forward, 1 step back on all forms of blended and catalytic finance. So whether it's philanthropies taking the first risk or developing a project, you know, and the early movers. So again, I beat up on the GP community early on. To the extent any institutional investors in the room or any of your members do Fund 1 that focuses on Africa green infrastructure, lots of other investors are going to wait for Fund 2, Fund 3. They want to see the track record of Fund 1. If you're doing Fund 1, our research would say you'll get a better return because Fund 1s with good teams tend to outperform Fund 2 and Fund 3, where they raise a lot more assets and aren't as hungry. But you're also creating a track record that will make other investors more comfortable doing it. And the same would apply for offtake coalitions stepping in and saying, we'll write this contract in Ghana and we'll take the currency risk, and you know, we know there have been issues there and so on. We're gonna take that risk off the table to make this investable, I picked on Ghana, but any country that has a history of currency instability or any kind of issues, you know, the offtake coalitions, if they're willing to step in on that can really help de-risk the deal.
Doing business in Africa, you can't afford to be without Africa Investor.